So, but let's stay on this theme of bonds and gold, Bob, and debt. All of this has led to this exploding debt. Right now, we just passed 38 trillion. We're expected to reach 50 trillion in like 4 years or less. As debt servicing, which is currently bigger than defense spending and more than a trillion annually, continues to grow, and debt velocity is growing, so seemingly does the pace at which central banks around the world are de-dollarizing and turning fiat dollars for gold instead of treasuries. How much of a problem is this for the US that as more and more debt is issued, less and less foreign buying of debt as a percentage is occurring in lieu of gold? This backdrop creates a situation where the US has less sway and authority over other countries because they would have less treasuries in their possession, but it also puts more pressure on either American citizens, institutions, or the Fed to make up the difference. Can you walk us through these concerns?
Yeah, I mean, I think the the general picture of what needs to happen in order to pay off all this debt. Like that's what I look at when I think about all this debt that's getting issued. Is like, how are we going to pay all this back? Like the way, and you can go back and you can look through history when you see countries with debt levels at this level. It happens with some regularity. If you go back to the last few hundred years across developed economies, and basically there are two ways in which it eventually can get paid off. The first, which is maybe the more hopeful path, is that you have a productivity boom, and that is certainly a possibility. I'm not ruling that out. I think I would be I'd put myself as a little more cautious about the likely technological benefits of AI and things like that than certainly some of the techno optimists. But that would be one path. But usually, and that was basically the path that emerged post World War II, because we went from low productivity to much higher productivity. It was basically the best productivity boom that any economies have experienced ever in human history or recorded human history. So we could have that. That seems like a lower probability than we take the normal path, which is to just inflate your way out. And the way you inflate your way out, it can be much more subtle than, we have 50% inflation or something like that. Like just the process, as a simple example of keeping interest rates a little too low, bringing the yield curve down, and keeping long end bonds bond yields low relative to inflation, which means you have sort of a weak real return. You can start to erode that existing debt stock. If you erode it 2% a year over 25 years, you've halved the debt stock, and that isn't that painful an outcome. In fact, if anything, it's the least painful outcome. But
You're talking about negative real returns, right?
yeah, negative real returns. Look,
And
bonds over the course of the next 25 years are going to have negative real returns.
so
Like
more and more countries are going to recognize the negative real return, and they would move towards gold or an alternative investment rather than losing the money, though, right?
I think that's basically what we're seeing. A lot of the diversification we're seeing so far has happened. I mean, through some accumulation of gold, but also through allowing the price to rise and not rebalancing back into bonds. Right? By not rebalancing back into bonds, they are making an explicit decision that they
Right.
like gold more than they like bonds on a forward-looking basis. Right? And so I think that's basically what we're seeing all these central banks do, is they're basically say, not only do I let the price run, but also I'm going to buy more to even add further to my stock, because that is likely to deliver a better real return over time.